I am very cautious on equities for the next, several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out that say the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in
Yeah.
March, it's possible the market say front runs that, and then it never gets the big sell-off that some of the bears expect.
Lyn Alden, a well-regarded financial analyst and commentator, shares insights on Bitcoin's impact on the global economy, its ongoing performance, and liquidity considerations in an interview. Alden asserts that Bitcoin, resembling a commodity more than a security, will remain largely immune to regulatory enforcement. Liquidity, which refers to the ease and speed of buying or selling an asset without affecting its price significantly, is a crucial factor to consider for investing in any asset, including Bitcoin. The halving event, which reduces the supply of new Bitcoins entering the market and potentially increases prices, may not always have a clear impact on Bitcoin's price, according to Alden. Various factors, such as demand from buyers and sellers, regulatory changes, and market sentiment, can influence it. Nonetheless, she emphasizes that Bitcoin's recognition as a digital commodity rather than a security makes it less susceptible to regulation, allowing it to remain relatively unaffected. Before proceeding further in this video, make sure to hit the subscribe button below for more recent updates on market.
Basically, some people, what they do is they put Bitcoin in a different segment where they say, this is something I'm not going to touch for a certain period of time. Kind of like how if you have physical gold in your house versus say a paper gold in your portfolio, you might treat them differently. You might say that the physical gold price, I'm not going to worry about timing anything, whereas the paper gold, I might try to do that. I think this is the same for Bitcoin. I think there's, if you define yourself as a Bitcoin trader, you want to focus heavily on things like liquidity. I've done a lot of work on trying to figure out what are the main factors that are the strongest correlation with Bitcoin price. So, historically, one of the ones is the halving, but that's actually not really good for a specific timing purpose. Generally, liquidity and economic indicators are better. So, if you put it simply, if you buy Bitcoin when the PMI is rising, you're going to have a better time than if you buy Bitcoin when the PMI is falling. And if you want to get more precise than that, if you look at various liquidity indicators, they generally front run PMI a little bit. And Bitcoin also tends to front run PMI a little bit. So actually the closest correlate that I've generally found for Bitcoin is various measures of liquidity, both domestic liquidity and then global liquidity, including, say, dollar-denominated global M2 in rate of change terms. Those are the types of things that correlate heavily with Bitcoin. And so in any sort of like near-term environment, if you're trying to judge what it's going to do in a multi-week or multi-month period, you have to generally have a decent view on what liquidity is going to do. Whereas long-term, you can look at things like, what percentage of the supply is liquid versus like tightly held. What are the developments happening on that whole ecosystem? So what is making Bitcoin better to use, better to interact with? What are the other technologies kind of building on that whole stack? And so the way that I view Bitcoin is I have this kind of long-term holding, this very long-term structural view that I occasionally check to make sure that thesis is still in place. But then I use the shorter term stuff, the cyclical stuff, to one, manage position sizes, and then two, set expectations in a near term.
Lyn Alden explains that when the Federal Reserve purchases debt instruments such as treasury notes or mortgage-backed securities, it aims to raise their prices and decrease yields, indicating a more relaxed monetary policy to bolster the economy. Conversely, selling Fed assets is a method of tightening policy that restricts financial conditions and asset values. Unsustainable levels of debt are hampering central banks' ability to address growing inflation. Restraining economic growth decreases the ability of governments to reduce deficits. Further, the political cycle results in difficult but necessary policy decisions around fiscal constraints being deferred. The result is a yo-yoing of rate rises and bailouts. This increases the risk for all types of investment, even traditional safe havens. Banks struggle and depositors run. In our assessment, the banks we rate have a manageable level of risk from unrealized losses, primarily due to their robust liquidity and capital positions. Additionally, the increase in earnings resulting from rising interest rates has further strengthened their financial health, providing additional support.
Earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs
Mhm.
overlaid on top of that. And if you look at the Federal Reserve's own balance sheet, I mean, they're in the red. They're operating at a loss now because their liabilities adjusted upward very quickly. That's a policy they decided to do, and essentially we're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up from with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of, I think, an ongoing profitability problem among those small and medium-sized banks. And then it's obviously further exacerbated by some areas of actual credit concern, things like autos, things like commercial real estate that are well-known issues at this point.
In a warning, Lyn Alden cautions that lifting the debt ceiling will require Janet Yellen to refill the Treasury General account, resulting in a liquidity crunch that could trigger a recession and cause stock prices to plummet. On the other hand, failing to raise the debt ceiling means the Treasury Department cannot issue new debt to fund government spending, putting the government at risk of defaulting on its existing debt obligations. Alden emphasizes the critical role of the Federal Reserve in providing liquidity to the financial system. If a Treasury cannot issue new debt, the Fed may need to intervene through open market operations to provide additional liquidity, which could impact its balance sheet and its ability to conduct monetary policy effectively.
That's part of why this is a challenging market, because it's so human driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do. So there's a couple ways they can handle that. One is that obviously if they reach very low cash levels, they can shut down the government for a period of time to extend the period that they can operate without an outright default on some of the more either essential payments or the debt itself. So they can extend it with that a little bit, but that obviously has an economic impact on its own right. And then essentially when they eventually have the debt ceiling impasse, one or two things has to happen. Either the Federal Reserve might have to provide more liquidity, which is awkward given their current inflation mandate, or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now, and it also deviates from their normal kind of plan of maintaining rather consistent average durations. So I think that's going to be a big challenge for them, and it's just this multi-month period of we see decelerating profit margins, we see decelerating growth, we see across the spectrum. If you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now. And I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And
Lyn Alden is issuing a warning to investors, highlighting the potential risks posed by regulatory enforcement actions and excessive leverage. However, she distinguishes Bitcoin from the broader crypto space, citing its status as a digital commodity and stronger decentralization fundamentals, which could potentially insulate it from the worst effects of such regulatory measures. Alden emphasizes that the high noise-to-signal ratio in the crypto space further highlights the need for investors to exercise caution and due diligence. Do you agree with Lyn Alden's perspective about liquidity situation, ongoing crisis, and Bitcoin performance? Share your thoughts in the comments section below. If you found this information helpful, then like this video and subscribe to our channel. We will bring you more updates in the future.